send you off to college, etc. So there are different kinds of objectives that you may have, short-term or long-term. And there are lots of obviously choices. Pick stocks, mutual funds, ETFs, put it in savings. You can do it yourself, or you can engage a professional. One of the things to consider in addition to your objective is the need to diversify your risks. Have everything in one bucket, because no matter how good an analysis you do, you know how fast things are changing. Your generation is changing things, and the generation ahead of you is changing things, and companies that you don't hear of anymore, and not the reason you don't hear of them because they've had new developments come along, new companies come along, new ways of getting things done and more efficiently, electronically, digitally. Internet also made it tough for those who are trying to sell paper books or magazines or newspapers. You got to change. You got to be with it, and therefore you do need to have diversification. You're also involved in an environment that's changing very quickly. The individual investor as such, as a population, is shrinking. More individual investors are going to professionals, buying mutual funds, doing other things, and picking themselves. It's also become much more international in scope. Now, from the way I was brought up and the way our publications are oriented is primary emphasis on fundamental analysis. Now, fundamental analysis means looking very carefully, first of all, what is the business or businesses in which your investment that you're looking at is involved. What are the opportunities there, or what are the risks there, and what are the risks there. Look at things like price-earnings ratios. What is the price of the stock versus what is its earnings expectation? Not just today or looking back, but trying to look forward with the best info you can put together on what may be the growth potentials of the company. The steadiness of earnings versus the volatility factors that may be built in. A company that is producing Kellogg's cereal, it is a fairly stable sort of environment in which it operates. Something that is a company that's producing, whether it's automobiles or something else, could be very full of ups and downs in terms of what its market opportunities are. When we start to look at stocks, we look at these factors. The 5-year, we try to anticipate, try to estimate 5-year potential growth opportunities for earnings, relate earnings, let's say, to price, relate earnings to book value, and we look at debt to assets of a company, and very importantly, we look at its liquidity. How much money does it have for investing in its future or otherwise employing? What is its cash flow? And there is a measure examine the recent quarterly results, the earnings, the sales, the margins, management expectations. Nowadays, many managements will give you some forward indications of what they think, public companies, what they think may be prospectively, at least in the near term, in their view, realizable. We compare a company that we're looking at to others in its industry to see whether the stock is priced higher or lower, whether its prospects better or worse. And we look at the potential for cash flow. We use, as in addition to the very basics of fundamental analysis, we have used for several years a process of a system, if you will, of ranking the statistics on what are the future expectations. And they rank hundreds, thousands of companies in various of these factors. Put together an average of those and come up with a figure. If it's 80, it's pretty good looking in terms of the overall average of its price earnings, of its expected growth, its cash flow, its price to book, etc. And we look at companies as a first screen. Does it have